Hey everyone, this is Hunter Satterfield, the CIO of Kane Waters, as well as one of our partners. As always, I am joined by Brian Bortz, one of my fellow partners and the head of the CWA Investment Committee, and then also Brad Sanders of Tectonic Advisors. We've got a lot to talk about. This is your February market update. For the month of February, S&P 500 was down right at 3%. The global stocks were down at 2.3%. Domestic bonds were down 1.1%, and global bonds were down 1.2%. So, Brad, everything was down for the month, and we've obviously got a lot of questions that are out there. I want to start first about the international issues that we're dealing with. Can you talk a little bit about just Russia and what all is kind of going on with that and what kind of things it's creating in the market?
Sure. I think when you have something like this going on, it's important to try to internalize that there's the human side of things, and then there's the financial side of things, and the markets react to the financial side. And that's not always in line with kind of how we're feeling. So I think a lot of times you see stuff like this happen and you try to project like any of the angst you're feeling onto what your portfolio is going to do, and those don't usually jive. The market's roughly where it was when this invasion happened, within 1% or so. It feels like it's down a lot though, because we've had like big down days and then a big rip up, and then it's been super volatile around that. And you have to understand that from a stock market perspective, this kind of permeates everything. You know, Russia provides energy to us and to Europe in the form of oil. They provide most of the natural gas to the European continent. So when you start disrupting things like that, it's not just the stock market that's going to react. You're going to have commodities markets. Now you're going to have financial markets because they're imposing all these sanctions on Europe. And, you know, they kicked them out of SWIFT. For those that don't know what that is, that's the Society for Worldwide Interbank Financial Telecommunication. Try to say that 5 times fast. But basically what it is like, if you can imagine, if you had a relative in Russia and you wanted to send them some money, it's not as simple as getting on your computer and going, send Aunt Joe, you know, $50. It's got to bounce around a bunch of banks. Well, if you kick Russia out of that, this is a very generic example. If you kick them out of that, the money can't get there, right? So there's kind of 2 forms of warfare going on here. There's what Russia's doing to the Ukraine, which is like traditional. Now you have all these economic sanctions, which is bigger. And we're going to see more and more of those the longer this goes on. And the more Russia intrudes into the Ukraine there, and it's just going to cause volatility in the market. At the end of the day, the last couple of times we've had conflicts like this, the market went up, you know, afterwards, even though you don't think it should. The market seems to be trying to just shrug everything off and press higher, but we've got a lot of this other stuff going on with interest rates and all that. So, you know, it's just a time to try to disassociate your kind of human feelings and your empathy and all that from your portfolio. And when you're thinking about your portfolio, try to think about it in terms of, do I have like any risk exposures here? Do I own a bunch of oil stocks or something? Or do I own a bunch of natural gas stocks? Do I own a ton of smaller banks? Think of it in terms of that, and not what's going to go down if Russia does X, because in general, that's not the way it works.
Yeah, that's helpful. Thank you. And that name for Swift, you can't say very swiftly. So there's your dad joke for the day. Hey, let's talk domestic stuff real quick, Brad. I want to come back to you again. Obviously, we've had some inflation prints that are very, very high. We've got pending interest rate hikes that are coming from the Fed here in the next few weeks or so. Can you talk a little bit about kind of the expectation that you guys are seeing over at Tectonic with both of those things?
Yeah, so interestingly, Powell came out yesterday afternoon and reiterated, it might have been Tuesday or Wednesday. We're recording this on a Friday. So it's in the last 2 days. He came out and said that they are going to raise in March. He reiterated that. It's going to be a 1/4 point. I think that's pretty close to 100% now. There was a lot of speculation that he was going to do a half. We never really believed that. We thought maybe there was a chance, but it's probably almost a certainty that it's going to be a 1/4 point rate hike. We're probably going to get another one in the summer if everything goes well. And then we'll see about the fall, kind of take that on a case-by-case basis. You know, the market's already priced in 4 to 5 1/4 point rate hikes. This bond market's way different from what you might have heard your parents talk about. Back then the Fed wasn't transparent. When Alan Greenspan came on TV, it was an event, right? You didn't know what the dude was going to say. We know exactly what the Fed's going to do. They tell us ahead of time. They have dot plots. It's a surprise when they go off script now. So they're following the script. They're basically about to do what they told the market they're going to do. That's why the market's been so volatile since December, is when they said, hey, we're going to start hiking and we're going to start tapering. And that's what the market was in the business of pricing in. And then we got distracted with Russia on top of that. So we do think you're going to get that rate hike in March for sure. We'll see one in the summer. Interestingly, the last time the Fed was hiking rates at Tectonic, we look at something called the 5-10 spread, and it's just the spread between the 5-year Treasury yield and the 10-year Treasury yield. And the last time the Fed was hiking rates, right after they hiked for the third time, the 5-10 spread went negative. What that means is the yield curve inverted, so the yield on the 5-year Treasury was higher than that of the 10-year Treasury for a moment. And that signaled the Fed was done raising right after that. Interestingly, the 5-10 spread went negative a couple weeks ago. So there's a lot of speculation about we're going to get 12 rate hikes and just big numbers being thrown around. The market's telling you they're going to get a couple of these in, and then rates are going to stall out and maybe have to come back. I think we're going to really hyper focus on that and keep our eyes on that as we move forward. If you don't get that yield curve steepening, and you don't, a lot of their tapering doesn't really work, this is going to be a short-lived hiking cycle from the Fed, regardless of what you might hear from some fear mongers out in the media.
Yeah, that's helpful. And it is something that we've talked about in our previous videos, that this is why that volatility was there, because they were starting to price, the market was starting to price a lot of this in. So thanks for kind of the follow-up on that. Brian, let me come over to you. Obviously, you're working with clients each and every day, and I know you're fielding a lot of calls on all of these topics that we just mentioned. You want to talk a little bit about the things that you're communicating with clients on right now in light of all of that?
Sure. Thanks, Hunter. Most of the clients that are calling me, I'm trying to give them one simple message, that the economy is not the stock market. Those are two different things and they move differently. We have said on every one of these broadcasts for more than a year now, the word volatility. We're seeing volatility right now. But, Russia's invasion of Ukraine is another piece of that. But you have to take a step back and realize that both Russia and Ukraine together only make up about 2% of the global GDP. So they're a very small piece of global GDP. When we look at our own economy, the things that I want our clients to understand is that our economy is still growing and it's still strong. And that's why the Fed is looking at trying to curb inflation. We all agree that a rate hike is coming. When you look at the other economic factors that are there, today there was a jobs report that came out that showed that the labor market was super strong. Last week, the Dallas Fed released a study that showed that manufacturing and factory activity was still growing and that the general business index was up. And so you have all of these economic indicators that are saying that we have a strong economy. And yet you have, really big down days in the stock market, followed by really big up days in the stock market. We're all over the board. So I'm telling our clients, this is an opportunity for you to stress test your risk tolerance. This is the perfect time for that. We really focus the way that we invest our clients' money based on what an appropriate allocation is for them. And this is an opportunity to talk about how much downside they're willing to look at and how much upside they're willing to look at and stress test their allocation. So I'm taking it as an opportunity to talk to our clients about reassessing where they are.
Yeah, that's helpful. I mean, because we've seen obviously a market that's continue to go up, just this slow creep up. And now as we introduce some volatility, and it is really good for us to be able to communicate to clients that, hey, like this is when you actually take a look and see what your risk tolerance is and the like. So thank you, gentlemen, as always, really helpful information for our viewers. As always, viewers, we will be back in front of you at the end of March. Thank you so much.